Welcome back, deep divers. It's great to be with you again. We're finding ourselves surrounded by stacks of books here at the Spill Bean Cafe. Actually, a pretty perfect setting to, immerse ourselves in knowledge. It might be a bit warm outside, sure, but inside, we're definitely ready to unpack a fresh set of your sources today. Our mission, as always, is to sift through all the noise, extract the most crucial nuggets of knowledge, and give you that valuable shortcut to being truly well informed. We're here to guide you through the material, highlighting what really stands out and why it matters to you. Before we dive in, though, we're incredibly grateful to Human AI. They're an innovative, decentralized AI alliance, really committed to bringing humanity back into the loop for AI. They're driving solutions for Web3 companies and data and storage. It's really cool stuff. And a big thank you also to our friends from the Old Foundation. If you're curious, you can download their old wallet, join their data hub, and actually get rewarded for contributing your data. Okay, so today we're kicking things off with a major macro level event from last night. Then we'll move into some groundbreaking legislation, the evolving landscape of digital assets, and even some surprising connections to popular culture. Let's get started. So let's unpack this first, and we always keep a close watch on two critical macroeconomic indicators, right? The monthly inflation data and the decisions coming out of the Federal Open Market Committee, the FOMC meeting. What exactly happened last night? Around 10:30 p.m. Standard Time, 2:30 p.m. Eastern.
Well, the big news is the federal chair decided to hold interest rates steady, kept them the same. And this is a significant macro-level decision because, well, like it or not, these choices directly influence the prices of Bitcoin and other cryptocurrencies. They really dictate the broader economic environment for these kinds of risk assets.
Right. And that decision, keeping rates the same, I saw some describe it as a bit strange. Why? Especially, given the current state of the U.S. economy.
Precisely. That's the interesting part. The U.S. economy is actually demonstrating remarkable strength right now. I mean, unemployment figures are at historic lows. And recent economic data has been, well, exceptionally promising. Really great, actually. Some reports even suggest employment growth could be the highest it's been in 40 years.
Wow, okay.
So given this robust performance, many observers felt it was, an opportune moment. Maybe even a perfect time to consider reducing the interest rate.
Okay, so hypothetically, if the rates had been reduced, what kind of impact would that have likely had on Bitcoin?
Well, from a macro perspective, a reduction in interest rates usually makes it cheaper for people and businesses to borrow money. And when borrowing costs are lower, more capital tends to flow into, let's say, riskier assets.
And Bitcoin's definitely in that category.
Absolutely. So that could have provided a very powerful push for Bitcoin's price. Now, holding rates steady isn't necessarily negative, don't get me wrong, but a reduction, that would likely have generated a more immediate and noticeable uplift. Could have been better, maybe.
Gotcha. So as our listener maybe plans their weekend, what's one key metric they should perhaps keep an eye on?
I'd say definitely monitor the volume of stablecoins. You see, the decision to maintain interest rates rather than increasing them is generally seen as indirectly positive for Bitcoin and crypto. So we should probably anticipate an increase in stablecoin volume as market participants potentially get ready to deploy capital.
Okay, makes sense. Shifting gears just slightly, there's been quite a bit of buzz around potential leadership changes at the Federal Reserve itself. What's the latest on that?
Yeah, that's a critical development too. There was a recent Supreme Court ruling which clarified that President Donald Trump does have the authority to remove Jerome Powell from his position as federal chair. And adding to this, Powell himself actually stated at the Senate last week that there's a very high chance he might be stepping down.
Oh, interesting. So who are the potential successors being talked about, and how might a change in leadership influence future policy?
Well, should Powell indeed step down, a couple of names are being widely discussed. Kevin Walsh, or maybe Scott Bessent, who's currently the Treasury Secretary. Now, if either of them were to take over as federal chair, the current speculation, and it is speculation, suggests they'd be more inclined to actually reduce interest rates.
Ah, okay.
And such a move, yeah, that would be highly beneficial for the prices of Bitcoin, other cryptocurrencies, and likely boost those stablecoin volumes we just talked about.
And what about the broader implications, beyond just crypto prices for the U.S. globally?
Right. Well, to put this in a wider context, look at Europe. They've been consistently reducing their interest rates for the past, 10 months now. And that's been pretty instrumental in stimulating their economic growth.
Yeah.
So it's truly puzzling to many why the U.S. Fed hasn't followed suit, especially given that U.S. inflation data has steadily declined for the last 3 months. And interestingly, even the tariffs seem to have contributed to this downward pressure on inflation, which is a bit surprising.
Yeah.
And on a different but kind of related note, President Donald Trump has recently secured, I think the figure is over $10 trillion worth of investment commitments, including significant agreements during his recent visit to the Middle East. Now, these investments are already translating into foreign companies starting operations in the U.S., which in turn is bolstering the labor market conditions.
Right. We mentioned the low unemployment.
Exactly. The U.S. labor market is arguably the strongest it has ever been. Now, the full economic impact of these huge investments, that might take 5 to 10 years to really materialize. But the initial phase of job creation, that's already well underway. It's kicked off.
Okay, fascinating stuff on the macro front. Now, here's a development that really got our attention. A significant legislative move happened on the 17th. Tell us about this Genius Act.
Ah, yes, the Genius Act. This one directly addresses stablecoins. It successfully passed the Senate and is now progressing to the House of Representatives. And honestly, there's an extremely high probability, close to 100%, that it will become law.
Okay, so what are the key provisions? What does this act actually say about stablecoins, and how does it compare to what other countries are doing?
So the act primarily focuses on U.S. dollar-backed stablecoins. It mandates that they must be fully collateralized by highly liquid assets, think actual U.S. dollars or short-term U.S. Treasury bills.
Right. Liquid.
Exactly. And what's fascinating here is that this approach bears a strong resemblance to regulations the UAE already enacted maybe 6 months ago or even more. The UAE is, frankly, quite far ahead in its implementation.
Really?
Yeah. In the UAE, stablecoins must be backed by the UAE dirham, the UAM. You've got examples like AEN, Tether operates there, and even Abu Dhabi Bank is working on ADTM. You can actually spot their symbols in everyday places, like Carrefour supermarkets.
Wow. Okay, this brings up a more foundational question for the crypto space, doesn't it? Are stablecoins effectively just stepping into the role of traditional banks? And if they are, do they genuinely align with that core ethos of an open, permissionless blockchain?
It's a great question. From my personal perspective, many of these centralized stablecoins like USDC or USDT, well, they function quite similarly to what you could call backdoor CBDCs, central bank digital currencies, essentially. And when we consider the broader implications for decentralization, this setup is, well, it's pretty far from that ideal, isn't it?
How so?
Because unlike truly decentralized protocols, these centralized issuers retain the ability to freeze accounts, to shut down specific addresses, block transactions, which means they aren't truly permissionless or pseudo-transparent in the way Bitcoin or Ethereum aim to be. They are, in essence, kind of a repackaged form of centralized finance, just running on blockchain infrastructure.
So if they are operating with some of the functions of banks, I mean, does that mean regulation isn't just necessary, but maybe even overdue?
Well, the core issue here is if these entities are indeed replacing traditional banking functions, then yes, I do believe regulation is essential. However, the nature of that audit, that regulation, is crucial. It shouldn't be solely entrusted to, say, government employees behind closed doors.
Okay.
Instead, it should ideally be transparent and accessible to the public, maybe 24/7. So anyone can verify that issuers like Tether or USDC genuinely hold the reserves they claim to hold.
Right, proof of reserves.
Exactly. And this is precisely why I'm personally a strong proponent of algorithmically backed stablecoins. They remove the need for a central issuer and, by their very design, offer a higher degree of transparency and decentralization.
But realistically, for many users, especially businesses, the intricate technical details of how a stablecoin is backed might not be their primary concern, right?
Absolutely right. I mean, if you're a real estate developer, for example, your focus probably isn't on whether it's algorithmically backed or centrally issued. Your main concerns are liquidity. How easily and quickly can you convert these stablecoins back into fiat or other assets? And the speed of the transactions. Practicality often trumps philosophical purity when it comes to mainstream adoption.
Yeah, that makes sense. And maybe a critical question in this whole conversation, have central banks themselves ever really undergone real audits of their own reserves and operations in the way they're demanding of stablecoins?
Huh. That's the million-dollar question, isn't it? The short answer is no, they haven't. It's a striking double standard, really. If central banks are demanding such rigorous transparency from stablecoin issuers, showing their papers, as it were, well, they should probably lead by example and open their own books to real independent audits. Fundamentally, Bitcoin was created partly to offer an alternative to, and in some ways remove the necessity of, traditional banks.
Not just replace them with a digital version.
Exactly. Not just replace them with a new form of centralized digital currency that acts just like them.
Okay. Are there any interesting alternative stablecoin models popping up or other significant impacts we should be aware of?
Yeah, an interesting point to consider is the growing discussion around privacy-focused stablecoins. There's talk of things like Freedom Dollar, which is
Mhm.
reportedly backed by the Zano blockchain.
Yeah.
It's a bit exotic, sure, but it represents an intriguing direction for stablecoin innovation focusing on user privacy.
Mm.
And beyond the technical stuff, we shouldn't forget that stablecoins have genuinely brought immense ease and reliability to many businesses, especially in the global south. We've seen communities, like in Egypt, for example, using USDT to preserve their savings and protect against really high inflation. It provides a critical financial lifeline for many.
Right, that's a really important use case. What about the big tech giants? Are they looking to get into the stablecoin game?
Oh, definitely. The Wall Street Journal recently reported that both Amazon and Walmart are exploring launching their own stablecoins. And this Genius Act we talked about will likely facilitate that.
That could be huge.
It could. It could lead to substantial cost reductions for these massive companies and potentially disrupt traditional banking even further. And just think, if we connect this to the bigger picture, think about the massive global market for remittances. Imagine an Indian rupee, INR stablecoin, for instance. That could make sending money across borders faster, cheaper, and far more reliable for literally billions of people.
Yeah, the potential there is enormous. Okay, let's shift our focus now to some interesting, maybe slightly stranger happenings on the Solana blockchain, particularly involving something called Pump Fun.
Ah, pump
Whoa.
fun. Yeah, their X account, Twitter, experienced a temporary 24-hour suspension recently.
Mm.
It seems the founders may have been, let's say, pumping up quite a lot of things and perhaps breaking some regulations or platform rules. There are also persistent rumors flying around that Pump Fund is planning a token sale, aiming to raise something like $1 billion.
$1 billion, wow.
Yeah, which would project a total project valuation of around $4 billion. Big numbers.
This actually reminds me of that Black Mirror episode, 15 million merits, I think it was, not common people,
Oh, right, 15 million merits, yes.
where individuals went to really extreme, disturbing lengths, even self-harm, just to earn virtual currency on some platform for, like, societal validation. The parallels seem kind of stark here.
Yes, exactly that episode. Characters engaged in truly, well, scary acts, like that guy continuously eating for hours, or even self-mutilation, all just to accumulate currency on a system that felt very much like a twisted version of what these meme coin or pump and dump platforms can sometimes enable. It definitely raises ethical questions about these incentivized platforms.
For sure. Speaking of ambitious, maybe slightly scary tech, what are your thoughts on Neuralink, Elon Musk's venture, and its potential future implications?
Neuralink, yeah. A key point to consider with Musk's Neuralink is its incredibly ambitious goal to enable direct thought-to-thought communication, potentially allowing us to, like, edit our thoughts before sending them, much like you'd edit a WhatsApp message.
Sounds like pure science fiction.
It really does. But the technology is already achieving some remarkable feats. It's helping completely paralyzed individuals perform tasks much faster than traditional human interaction allows, like playing complex video games just with their thoughts. At its core, I think the philosophy guiding this development is really built around trust. Trust in the technology, trust in its potential to augment human capabilities, but obviously big ethical questions too.
Huge questions. Okay, turning now to global events. How has the current geopolitical chaos, say between Israel and Iran, impacted the crypto market compared to past events?
Well, one really notable observation is that unlike previous major geopolitical upheavals, think about the Russia-Ukraine conflict starting, or the initial shock of COVID-19. The ongoing Israel-Iran conflict has actually had a surprisingly muted effect on Bitcoin and the broader cryptocurrency prices.
Really?
Yeah, Bitcoin saw only about a 5% drop in the immediate aftermath, which frankly, from a market perspective, isn't considered a big deal in response to such a major global event.
So does that mean we're seeing some kind of decoupling? Are macro-level factors maybe not influencing Bitcoin as much as they used to?
That's a possibility. Or perhaps the market is maturing. If we zoom out for a moment, traditional safe haven assets like gold have performed quite well during this period. Gold reached about $3,400 per kilo, I believe, suggesting a general flight to perceived safety in traditional markets.
Okay.
So this muted Bitcoin reaction could indicate a growing maturity in the crypto market. Or maybe that these kinds of geopolitical risks are becoming more priced in by sophisticated investors rather than causing widespread panic selling like they might have before.
Interesting perspective.
Unfortunately, though, amidst this whole situation, an Iranian cryptocurrency exchange called Notex was exploited, resulting in a reported loss of around $90 million.
Ouch.
Yeah, and rumors circulating, though unconfirmed, suggest an Israeli activist group might have been responsible. They alleged Notex was being used for notorious purposes and illicit financing.
Right. Regardless of the cause, that incident really underscores a critical lesson for our listeners, doesn't it? About custody.
Absolutely. This is exactly where that old crypto adage, not your crypto, not your keys, becomes profoundly relevant. It basically means if you don't hold the private cryptographic keys to your digital assets yourself in a personal wallet, whether that's a hardware wallet or a secure software one,
You don't really own it.
you don't truly control your money. In that Notex case, average Iranian users lost their cryptocurrencies with virtually zero chance of recovery, largely because of the war situation and the impact of Western sanctions making recourse impossible. It just highlights the paramount importance of self-custody, especially in times of geopolitical instability or heightened cyber threats. Control your own keys.
Crucial advice. Okay, finally for this segment, let's quickly touch on Bitcoin mining difficulty. What's happening there?
Yeah, an interesting technical development. For the first time in a very long time, the Bitcoin mining difficulty has actually decreased. Now, this difficulty adjusts automatically every 2016 blocks, roughly every 2 weeks, and historically, it has almost consistently trended upwards as more miners join.
So a decrease is unusual.
Very unusual. It suggests that it's currently extremely expensive, perhaps less profitable, for miners to produce a single Bitcoin right now. However, alongside this, we're seeing a really interesting new trend emerging, especially since maybe 2024, 2025. Bitcoin miners are now actively buying Bitcoin on the open market, not solely relying on minting new coins through mining.
Ah, like holding it as a treasury asset.
Exactly. This shift seems significantly influenced by figures like Michael Saylor and his whole Bitcoin treasury strategy for corporations.
Yeah.
We're seeing examples like Mara Holdings, which apparently holds around 49,000 BTC now, potentially making them the second largest corporate holder after MicroStrategy. And another miner, Spark, holds something like 12,500 BTC. So they're accumulating, not just mining and selling.
That's a significant shift in strategy. Okay, let's change continents now and shift our gaze to Southeast Asia. Could Vietnam truly be the next major frontier in the blockchain and AI space? What are you seeing?
Well, there are definitely some notable developments happening there. Vietnam has a new digital asset law set to take effect on January 1st, 2026. And this law formally legalizes digital assets within the country.
That's big.
It is. And concurrently, they're launching significant new initiatives in both the semiconductor industry and artificial intelligence. There's also just a palpable energy on the ground for crypto. You've got a booming economy, a proliferation of crypto events happening, many exchanges establishing a presence, and crucially, a significant number of really talented chief technology officers, CTOs, in the global crypto world actually hail from Vietnam. There's a strong tech talent pool.
So putting all those factors together, what does this mean for Vietnam's potential? Can they really compete on a global scale with established hubs?
Looking deeper at this, I think Vietnam is indeed positioning itself to compete directly with leading hubs like, say, the UAE, Singapore, maybe even challenge the US in certain aspects, especially in the digital asset domain. And interestingly, from a retail adoption standpoint, there's arguably more grassroots activity, more on-the-ground stuff happening there than even in a place like the UAE.
Really? More than the UAE?
Potentially, yeah, on a per capita or retail level. We talked earlier about people in places like Egypt using USDT to safeguard savings against inflation. Well, Vietnam is showing similar, if not maybe even greater, levels of enthusiasm and practical adoption among everyday users. It's quite vibrant.
Very interesting to watch. Okay, now let's turn to a well-known blockchain, Cardano, and a rather controversial suggestion from its founder, Charles Hoskinson. What's he proposing?
Yeah, Charles Hoskinson has proposed moving $100 million worth of ADA, which is Cardano's native token, into Bitcoin. And this move is specifically intended to serve as backing for Cardano-based stablecoins like USDM and USDA.
And how's that going down with the community?
Predictably, the Cardano community is. Well, let's just say they're not happy about this idea, quite vocal in their disapproval.
You know, this sounds strikingly similar, almost worryingly so, to what EOS famously did years ago, doesn't it?
It absolutely does. EOS made headlines back then when they raised that massive $4 billion in their ICO,
Yeah.
and then subsequently decided to invest a substantial portion of it into Bitcoin. At the time, that decision really did not make absolutely any sense given their stated objectives as a platform blockchain. And it raises similar questions about strategy now for Cardano.
So what is Hoskinson's rationale? Why does he think putting ADA reserves into Bitcoin is a good idea for Cardano?
His core argument seems to center on increasing Cardano's total value locked, or TVL. The core issue here, from his perspective, is that he views TVL as a primary indicator of a project's or blockchain's strength, its security, its ecosystem activity.
Okay, explain that a bit more.
Well, for instance, Cardano's TVL currently stands at around $356 million, which sounds like a lot, but compared to Solana, whose TVL is nearly $10 billion. So this implies, theoretically, it would cost attackers $10 billion to significantly compromise or rewrite Solana's blockchain history through economic means. But maybe only $356 million to do the same for Cardano. He believes adding $100 million in Bitcoin-backed reserves would directly boost Cardano's TVL figure, and by extension, its perceived strength and security.
I see the logic, but does Cardano really possess the same kind of real-world utility and dApp ecosystem that we see driving value on other chains like Ethereum or even Solana?
That's my main reservation, personally, with Cardano. As a layer 1 blockchain, as the foundational layer, it just seems to lack the same level of tangible, real-world use cases compared to others. When you compare it to Bitcoin, which clearly serves as digital gold, a store of value. Or Ethereum, which has this thriving, massive ecosystem of startups and decentralized applications actually building useful things on it.
Cardano feels a bit less utilized.
Exactly. Cardano simply hasn't seen that same level of practical adoption or dApp development take hold. You remember the narrative from a few years ago positioning Cardano as the Ethereum killer?
Yeah, that was everywhere.
Well, unfortunately, that narrative hasn't really materialized into widespread dApp usage or attracting significant developer activity compared to Ethereum.
And we can actually see this pretty clearly if we look at the data, the numbers for decentralized application usage, can't we?
Absolutely. To put this in a wider context, if we examine data from platforms like, say, Dapper.com, Ethereum's top dApp, Uniswap v4, the decentralized exchange, records over 14,000 unique active wallet interactions daily. We call that UAW. And even Uniswap v2, the older version, sees close to 10,000 UAW.
Okay, those are big numbers. What about Cardano?
In stark contrast, Cardano's leading dApp, whatever it might be at the moment, has a mere 718 UAW.
Only 718 compared to over 14,000.
Exactly. The difference in user engagement is just massive. It's almost scary how big the gap is. And this data strongly suggests that Ethereum has successfully fostered genuine value creation through its actual use cases. People are using it. While Bitcoin continues to solidly hold its ground as that robust form of digital gold, Cardano's struggling to find that same level of real-world traction despite the TVL arguments.
Right, the numbers don't lie there. Okay, let's turn to our final major topic, something that's generating, well, massive hype right now, real-world asset, or RWA tokenization. What's happening in this dynamic space?
Okay, RWA. First, just to put this in a wider context of the market, we've seen a really dramatic shift in decentralized exchange, DAX, volume over just the last 6 weeks or so. PancakeSwap, surprisingly to some, has truly been killing it. They've consistently held the #1 spot for trading volume for nearly 6 weeks straight now.
Overtaking Uniswap.
Yeah, overtaking Uniswap's volume, often by more than double, sometimes even triple on certain days. PancakeSwap's 24-hour volume is hovering around $10 billion recently, while Uniswap's is more like $4 billion. That's a big change.
Wow.
And related to this shift, a really notable development here is that data platforms like Dapper.com and Defilama.com, the big DeFi trackers, they have now actually incorporated RWA tokenization, total value locked, TVL, as a standard metric they display.
That's new, right? They didn't used to track that specifically.
Entirely new. It was never seen before as its own category. That tells you how much focus is shifting towards RWA.
It definitely seems to be the conversation starter everywhere these days. We're even hosting an event specifically dedicated to this topic, correct?
Yes, that's right. This Tuesday at 7 p.m., we'll be going live for a really deep dive into tokenization itself. We'll cover what it is, the mechanics of how it actually works, the various steps involved from asset to token, and importantly, the inherent challenges and hurdles.
And asking the tough questions, too.
Absolutely. We'll even explore that critical question. Do we truly need blockchain technology for all aspects of RWA? Or could some parts theoretically be managed using, a glorified Excel spreadsheet 2007? We need to cut through the hype.
Looking forward to that. Who are some of the key players really driving innovation in the RWA space right now?
Well, it's funny. A company called Security Eyes has actually been championing the idea of tokenizing real-world assets since way back in the ICO era, like 2017. But honestly, their vision was largely dismissed or ignored back then.
Until Larry Fink started talking about it.
Exactly, until BlackRock's Larry Fink began discussing the tokenization of everything, and suddenly, overnight, everyone became an expert on RWA.
Huh. Typical.
Yeah, and geographically, Dubai is also taking a leading role here. Dubai Land, the government entity, has already started issuing tokenized property assets. They're really pushing forward.
But let's address the elephant in the room. Is RWA tokenization just another hype cycle, maybe like what we witnessed with NFTs a couple years ago? Is it the real deal this time?
That's the key point to consider, isn't it? Is RWA tokenization a fundamental shift in finance? Or is it potentially just repackaged centralization, the same old systems dressed up with new blockchain terminology? We really need to challenge the hype constantly. Ask if it genuinely fosters a decentralized, open economy where anyone can participate frictionlessly, or if it will just replicate the existing financial gatekeepers and barriers to entry.
We saw how that played out with NFTs.
We certainly did. We saw NFTs, some digital assets sold for hundreds of thousands, even millions, that are now worth less than $3,000. Now, the underlying technology, the NFT standard itself, isn't inherently flawed, but the space undeniably attracted its fair share of bad actors and, let's call it, funny business folks. We need to be wary of that with RWA.
So hype aside, what are some of the more genuinely compelling or innovative developments happening within RWA right now?
Well, one striking detail is that even Tether, the massive stablecoin issuer, is making aggressive moves into RWA tokenization. They have a project called Hadron, apparently. And interestingly, they're planning to build this on the Bitcoin blockchain using Taproot.
On Bitcoin. That's interesting.
Yeah, Taproot is that Bitcoin upgrade improving privacy and efficiency for complex transactions. Tether claims it offers a very simple, like, 4-step process for tokenizing assets via this Hadron project. And beyond financial assets, other diverse things, like carbon credits, are also being actively tokenized by companies such as Lumi.
Okay, so various asset types.
Right. And look, to put this in a wider context again, decentralization isn't really an all-or-nothing concept, is it? It exists on a spectrum. So while these intellectual arguments about true decentralization are vital, practical application and real-world utility are equally important. And we are seeing genuinely compelling use cases emerge already, like the real estate tokenization examples in Dubai we mentioned. There was a case where properties worth a couple $1 million were reportedly sold out, on-chain, tokenized, in just a matter of minutes. That's efficiency.
That's impressive speed. And the fact that the big institutional players are seriously getting involved now, that does suggest something real is happening, doesn't it?
Indeed. When you see giants like BlackRock heavily focusing their strategy on this sector, and major asset managers like Besennett formally partnering with platforms like SecurityEyes, when these institutional behemoths start dedicating significant resources and building infrastructure, it definitely signals a serious long-term commitment and suggests a potential for much wider adoption than just a fleeting hype cycle.
Wow. Okay. What a deep dive today. We've certainly covered a lot of ground. We've unpacked the Federal Reserve's pivotal decision, thoroughly dissected the Genius Act, explored the nuances and debates around stablecoins, linked some of these tech trends back to a slightly unsettling Black Mirror moment, and even looked at the future of digital assets potentially booming in Vietnam.
And yeah, to zoom out just one last time, it's abundantly clear that the world of digital assets is just in this constant state of rapid evolution, isn't it? It's relentlessly challenging our existing assumptions about finance, about ownership, about value itself. And this really brings up a critical question, maybe a final provocative thought for you, the listener, to consider. As this real-world asset tokenization trend continues to gain momentum, how will that delicate balance the tension between traditional financial control and centralized systems on one side and the core ethos of open, permissionless, decentralized systems on the other? How will that ultimately play out in the years to come? Where will we land?
That is a powerful thought to leave everyone with. Excellent point. Before we sign off, just a quick word on some exciting initiatives we want to highlight. First, Human AI, our incredible sponsor. They are truly championing the idea of keeping humanity in the loop for artificial intelligence. They're providing tangible, practical solutions for Web3 companies in crucial areas like data management and storage. They operate as a nonprofit, a public good initiative, and they have some major announcements on the horizon. You can actually join their town hall meeting on X Spaces later today and definitely follow them on LinkedIn for all their updates and live streams. And second, for those of you who are deeply invested in or focused on Bitcoin specifically, there's a brand new project worth checking out. It's called Bitcoin DXP, and you can find it at bitcoindxp.org. That's BITCOIN DXP.org. This initiative is singularly focused only on Bitcoin education. They're targeting key audiences like politicians, high net worth individuals, educational institutions, lawyers, and even government enterprises, offering education at beginner, intermediate, and advanced technical levels, all about Bitcoin. They're actively seeking contributions and support to further their important mission. We'll make sure all the important links we discussed today, including Human AI and Bitcoin DXP, are available on our social channels for you. Thank you so much for joining us on this deep dive. Keep exploring, keep learning, and we'll be back next week with more. Be good, be safe, and talk to you soon.